In this video, we're going to talk about Progenity, trading under the ticker symbol PROG. In recent trading sessions, Progenity stock went through a lot of volatility, and things are looking quite encouraging for this battleground between short sellers and retail traders looking to short squeeze the stock. We're going to look at the phenomenon and determine whether you should be buying more PROG shares or not in the current situation. Before today's video begins, if you like my content and would like to see more stock analysis videos, please like, comment, and subscribe to my channel for more. Progenity is a company that operates in the health service sector, more particularly in the medical and nursing services industry. It develops and sells specialized diagnostic tests to clinics and was founded back in 2010. The company went public in June of 2020 at the height of the stock craze from last year. But unlike many of the stocks in the same period of time, Progenity did not manage to benefit from the rising tide. Its stock price initially traded at around $13, and since then, it has been a prolonged period of time of sell-offs, which reached a bottom of 67 cents in August of 2021. Part of the reason was market-wide, like the sell-off of startups across the board since February of this year, or the fact that the medical field in itself is not always very popular with investors. Many would suddenly pile in if there is a perceived momentum, but other than that, most investors, especially retail traders, would prefer to stay away from this very volatile sector, where the success of a company often depends on whether they manage to successfully develop one specific product. In other words, if they manage to grow one basket by putting in all their eggs in it, and many startups bit the dust trying to do so. But there is also another reason as well. Progenity is currently the target of quite a few short sellers, who are mainly the institutional traders. Their goal is to dump the shares in the market and then later recover the shares at a lower cost, which will provide them a gain because they essentially borrow those shares from the brokers. One key thing to understand about short positions is that they eventually have to recover the trades, regardless of whether they manage to make any money from it. For Progenity, there are 49.3 million shares that are being shorted in a dark pool at the moment, and almost 60% of the volume is positioned on the short side of things. Judging by the fact that the price reached a historic low in September, it shouldn't be surprising to see that their tactic has worked at least for some time. But from October onwards, the stock has managed, thanks to retail traders, it has managed to go higher and almost quadrupled in stock price compared to where it was just a month ago. There is also another major catalyst with the company itself. Progenity just managed to secure its patents for ingestible technologies. The market reacted positively to this news as the stock price is now above $2 and may manage to stay there for the foreseeable future. Personally, I think that the reason why it managed to take off on this news is not necessarily because of the fundamental update itself, but that it is used as a conduit or an excuse for the bulls to take over the control of the momentum, which will edge ever closer to squeeze out the short sellers out of their positions, because eventually they will have to recover their positions, and some would rather recover with a slight loss instead of a much more significant one. I would recommend to either keep your position or get in Progenity, not necessarily depending on its price action over the next couple of days, but within a time horizon of about 3 to 5 days from now, like within 3 to 5 days from now, in case the stock pulls back after the initial jump or not. And even if it doesn't, we have to keep in mind that the stock is probably going to go higher with the whole short squeeze play that is going on, which just goes stronger with the patents Progenity managed to secure. I would recommend to have a total exposure of around 1 to 3% of your portfolio in Progenity stock. The profit taking should be considered when there seems to be a pause from the upward momentum, which began back in September. Looking at the current environment, I think that we have to be careful with having exposures in the equity market. The market has been predicted to eventually go through a major pullback or even a recession for more than a decade at this point, and that its future outcome depends on a number of elements. First of all, after the quantitative easing years and a drastic increase in asset price and the corresponding decrease in their yields, we have to remember that markets are not a mirror of how the economy is doing, because otherwise we would have seen a market trading a lot more sideways. 2020 then saw another big push in asset prices, and this time not just for the blue chips, but also for the growth stocks. There are, generally speaking, two explanations. The first one is that more money has been printed across the world, and because the real economy is stagnating and has been stagnating over the years, the capital entered the huge melting pot of globalized finance and has been buying up asset prices ever since. That was the case for quite a while, but now the quantitative easing has been touching its end in North America and slowing down or even wrapping up in Europe. In other words, new money, printed or minted, will not necessarily be an important part in keeping the asset prices up or even higher. This decrease of new money is then partially compensated with the geopolitical tensions across the world. And the more tensions there are, the more money tends to flow to North America and the US, because it is still perceived as a safe haven for capital from different countries, especially the ones that are currently seeing turmoil or social unrests. One last phenomenon is the attempt of market participants to protect their capital not just by remaining cash-heavy, but to concentrate their purchases in a few specific sectors so that the asset price of those sectors remain high, not only thanks to good fundamentals, but because there is a very high level of demand. What all these mean for the market is that the degree of uncertainty will increase over the next month or years, especially as the expectation for a recession is building up after the Great Party of 2020. The recent announcements from the US Fed, as well as the accumulation of economic difficulties bubbling up from Asia, and the potential effects that it may have on other financial markets, all contribute to the fact that I think there will be some significant volatility ahead of us. So essentially, it is very important to keep the speculative plays at a reasonable level. A healthy portfolio normally contains a healthy percentage of its positions in sectors that are different and mature, with predictable cash flows, such as REITs, fixed income assets, and preferred shares. The rest can be invested in growth stocks or to remain cash heavy in case there is an opportunity to scoop the bottom. Overall, I think that the current environment does make me believe that there will be opportunities in future to average down for cost basis, and this is why the initial position should remain moderate, so that we can afford to average down further down the road. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.